Have you ever glanced at your payslip, seen that line for tax deducted, and just sighed, wondering if there was a way to legally shield some of your hard-earned money? Well, guess what? There is. Today, we're going to pull back the curtain on Section 10 of the Income Tax Act and find out exactly which parts of your income are totally off-limits to tax.
So, here's our game plan. We'll kick things off by nailing down the crucial difference between exemptions and deductions. Then, we'll look at income that's completely exempt, no questions asked. After that, we'll zoom in on us salaried folks, talk about retirement benefits, and wrap up with a few other key areas like awards and insurance.
All right, first things first, we have to tackle a really fundamental idea. What is the difference between an exemption and a deduction? They might sound the same, but trust me, understanding this distinction is the key to unlocking your entire tax picture. Get this right, and everything else just falls into place.
So what is the actual difference? Let me give you an analogy. Think of an exemption as a special filter on a water pipe. Certain types of income, they get diverted before they even hit your main bucket of income. The tax authorities never even see it. A deduction, on the other hand, is like a little tap on the side of that bucket. After all your income is in there, you get to let some out for specific reasons. So exemptions are excluded from the very start. Deductions are subtracted later on.
And this is the golden rule, right here. An exemption isn't some general discount you get on your final income. Nope. It is tied directly to a specific source. It's the type of money you're getting that makes it tax-free. That means we have to look at each kind of earning one by one.
Okay, now that we've got that sorted, let's jump into our first big category. Income that is 100% completely, fully exempt. This is the good stuff. Money that, as long as it fits the description, is totally tax-free. And as you can see, this covers a pretty wide and interesting range. Things like agricultural income, for example, are fully exempt. Same goes for any money you get from a Hindu undivided family, or HUF. Your share of the profit from a partnership firm is also tax-free, which is great. And so are scholarships for education and, importantly, the final payout from a life insurance policy.
All right, that's great for those specific cases. But what about the vast majority of us who are earning a regular salary? Well, this next section is for you. Let's dig into your payslip and see how these exemptions work in the real world, month after month.
Now, here's a really important heads up. Unlike those things we just listed, most of the allowances you see in your salary are not automatically 100% tax-free. Not at all. There are almost always rules, limits, or conditions you have to meet. So you can't just look at an allowance and assume the whole thing is exempt.
A perfect example of this is the house rent allowance, or HRA. To figure out how much is tax-free, you actually have to do three little calculations. You take the actual HRA you got, then you calculate a percentage of your salary, and finally, you take the rent you paid and subtract 10% of your salary from it. You get three numbers, and whichever one is the lowest, that's your tax-free amount.
And HRA isn't the only one, of course. Your payslip might have a bunch of others, and each one has its own set of rules. You've got Leave Travel Concession, or LTC, which can help cover travel within India. You might have allowances for your uniform, for transport, a helper, or even for research. Each has its own way of calculating what part is exempt.
Okay, let's zoom out from the monthly pay slip and talk about the long game. The tax system actually has some really great benefits to encourage us to save for the future, especially for retirement. Understanding these exemptions is absolutely crucial if you want to build a really tax-efficient nest egg for yourself.
This table really breaks it down nicely for the three main types of provident funds. If you're a government employee with a statutory PF, it's simple. Everything's tax-free. But for most of us in the private sector with a recognized PF, here's the deal. Your employer's contribution is tax-free up to 12% of your salary, and the interest is tax-free up to a 9.5% rate. The key thing to remember? Anything your employer puts in, or any interest you earn above those limits, that part becomes taxable. So that covers the monthly savings. But what about those big one-time payments you get when you finally leave a job? I'm talking about things like gratuity or a voluntary retirement payout. These also get some major tax breaks, but, and this is important, they come with very specific lifetime limits. Let's quickly run through the big ones. First up, we have gratuity. For anyone who's not a government employee, the maximum amount of gratuity you can receive tax-free over your entire career is capped at 20 lakh rupees. Next, if you get a payout for either voluntary retirement or because of retrenchment, when an employer has to let people go, the tax-free limit for that compensation is 5 lakh rupees. And finally, we have leave encashment. That's when you cash in all your unused paid leave at retirement.
For non-government employees, the maximum tax-free amount you can get from that is 3 lakh rupees.
All right, we're in the home stretch. Let's just quickly cover a few other really important exemptions that pop up in some pretty common situations.
So the government gives full tax exemptions for certain awards given out in the public interest. And, as a sign of respect, pensions received by winners of gallantry awards, like the Paramveer Chakra, are completely tax-free. The same goes for family pensions received by the families of armed forces personnel.
Some of your investment and family income gets a break too. For instance, under certain rules, income you get from specific mutual fund units can be exempt. And on the family side of things, if your minor child has an income that gets added to yours for tax purposes, you can claim a small exemption of up to 1,500 rupees per child.
So what's the big takeaway from all of this? It's that exemptions are not just confusing tax jargon. They are really powerful tools. Understanding which parts of your income are off limits to tax is the absolute first step to figuring out your real, true taxable income. And that knowledge, well, that empowers you to plan your finances way more effectively.
Look, at the end of the day, every single credit to your bank account, every line on your payslip tells a part of your financial story. So the question I want to leave you with is this. Now that you know what to look for, can you go back and figure out which chapters of your own story are and always should have been completely tax-free?